Bank of America has declared stagflation is here. Let's have a look. Hello everyone, Florian.Heise here and welcome to another episode of HeiseSays. I thought we'd have a look at this article from news.com.au written by Alexis Kerry discussing, well, stagflation is here. World economy at risk from multiple crises. Multiple crises, not just one. Now, let's have a look at this because there's a lot of fear and concern around stagflation. A lot of people are worried about it. But first, let's actually have a look at the definition of stagflation and then talk about this piece a little bit. We'll just jump here and I'll bring this up. We have a look here, everyone. So what is the definition of stagflation? Persistent high inflation combined with high unemployment and stagnant demand in a country's economy. Okay, now are we talking about the US? Are we talking about Australia? Are we talking about Europe or Japan? You know, the price is going to skyrocket. Are so many people going to be unemployed? Is everyone who's stashed their wealth in crypto, gold and silver going to be able to buy a hotel for a gold coin like in the Republic in Germany back in the day? That's what most people think when they think of stagflation. Now, we've got to think about a few things there. We're not talking Weimar Republic, Germany just printing dollars beyond dollars and no one wanting that currency. You know, we're talking, well, the US dollar. People are concerned there's going to be, there's printing dollar beyond dollar, but that's, bank reserves. That's not actually getting out to the people as much as it would. And there's still demand. There's still demand for US dollars. Let's have a look at this, the US dollar index. Now, the US dollar index, it's a value of the United States dollar relative to a basket of foreign currencies, often referred to as the basket of US trade partners' currencies. Okay, so the index goes up when the dollar gains strength when compared to other currencies. Okay, with that definition in mind, let's have a look here. We can see, hang on, there we go. This is the current US dollar currency index. It's sitting at 94.018. And if we changed, what are we looking at here? What time frame? There you go. I mean, this is all since earlier this year. And I'll just scroll down. Can I change the time frame? Can we go further out with this one? Let's go to 5 years. So we're certainly down lower. Okay, so it's gone down lower. And the last time we were at this level was back when, 2018. And we'll go a bit further out. We'll go all. So there you go. So it's not as strong as it was in 01. Where's 08? 08 about here. Yeah, it crashed right down. So we're still a lot stronger than the GFC. We're not really that high. We're kind of in the middle. So, yeah. No, nothing dramatic is happening here. Nothing here is showing that at least the demand for the US dollar, or the strength of the US dollar compared to other currencies, is shifting that much from normal. We'd have to start seeing that as well. So with that in mind, let's have a look at this, because we are seeing some inflation and we are seeing some increasing costs of goods and services. And a lot of that is to do with shipping. And what we'll do is we'll bring up here the shipping data. Okay, and we'll agree here. This is from marine traffic. And we can see, if we zoom in, just the amount of shipping that's, people will show images of this, just shipping that's backing up at the US, but it always looks insane, guys. This is the thing. There's always going to be shipping, and there's still delays from the Suez Canal incident and other issues that have manifested that are going to work their way through. It's going to take time for that to normalize. The cost of shipping going from the east coast of China to the east coast of the US, that's gotten very expensive as well. It's a very popular trade route that we can see right here, guys. It's gotten really expensive. You know what? Let's bring that up here. Hang on. I've got that here. Here we go. The Freightos index. Okay, and we'll go China to the east coast, $17,970. But if we see this chart right here, we can see it's actually come off the peak. Okay, so it's come off the peak. So with that in mind, let's have a look. We know what the definition of stagflation is. We've seen the rising cost of transportation. That's come off, and that's going to factor into the cost of a lot of imported goods. And let's have a look at this now. So, after months of surprisingly healthy economic results, it seems the tide is now turning, leaving the global economy at risk, and Australia is not immune to the potential bloodbath ahead. I mean, Alexis is definitely riding. There's a lot of fear out there about the economy. People are scared. People are worried. That's why, and rightfully so. We want to be prepared. In the early days of the COVID pandemic, there were widespread concerns it would cause a global recession. That did not come to pass, with stock markets surging since last March. Well, we had a recession here in Australia. Many countries have had recessions. What else is the definition of a global recession? Well, I guess globally our GDP hasn't gone down. Some countries are still growing. But here for Australia, guys, remember, we had our first recession in 28 years. But now it's a different story. In recent weeks, attention has turned to the problem of disruption of worldwide trade, the Evergrande crisis, and what it means for China's wider economic growth model, energy shortages, and the anticipation of a US government shutdown. With all of those factors sparking fear about the impact for the global economy. Well, Evergrande, here's the thing. It's going to have an impact on the wider Chinese economy. Sure, it will. It will, and that will flow through to certain parts of global trade that Evergrande and that model of growth there is demanding. But we'll see how it goes. I mean, all the businesses that have invested in Evergrande bonds, we're not talking AA super duper plus bonds, are we? We're talking junk bonds. They weren't rated that high, guys. You were paid for the risk you took. Sometimes the risk just doesn't pay off. The US government shutdown, that's a bit of theatre. I don't really think that's going to amount to anything. They've already extended it once. They'll do it again. And, energy shortages, that's people learning that renewables aren't reliable. That's what it is. Putting all your eggs in a dodgy wind farm basket is probably not the smartest thing. That's what scares me about this push for net zero in 2050, that they're looking at unreliable renewables. That means people are going to die. Okay, that's what it means. It has all culminated in the growing worry that we could be about to experience stagflation for the first time in decades. So what is stagflation? It is a term given to the extremely rare economic phenomenon the world hasn't seen since the 70s. In a nutshell, it refers to a situation where inflation rates are soaring while the economic growth rate slows down and unemployment is high. So you can see there's our unemployment rate. We're sitting at 4.5%. If you look at Roy Morgan's, you know what, let's just bring that up. Roy Morgan, unemployment. We'll bring that up here. And what are they sitting at? We'll scroll right down. 8.7. Roy Morgan is generally double the ABS stats, but as long as they're trending the same. It occurred in the 70s when the US faced 5 quarters of negative GDP growth in the wake of the oil crisis, coupled with the inflation rate doubling in 1973, followed by a 9% unemployment rate in 75. And my understanding is, during that time, wasn't that when Arnold Schwarzenegger made his fortune in property back in the 70s? Let me know. I know it was around then. So, it has not been seen since, but now experts are convinced it has made an unwelcome return. So stagflation is here. In an alarming warning, Bank of America analysts declared in a note on Friday that stagflation is here after months of climbing prices, with a government report also revealing US inflation was at a 3-decade high as of August. This is all happening at the same time as energy shortages are hitting China, Europe and the UK, an Evergrande collapse is looking more and more probable, and a US government shutdown begins to appear increasingly likely as the debt ceiling debate rages on. So, the October 18th deadline. America is facing a critical looming deadline amid worries of a US debt ceiling of $28.4 trillion being breached. So far, US Senate Republicans have thwarted moves to raise the debt ceiling, with Treasury Secretary Janet Yellen last week warning the US could run out of money and default on its debts as soon as the 18th of October, America's so-called X date, if it is not raised. At that point, we expect Treasury will be left with very limited resources that would be depleted quickly, Yellen explained in a letter to Congress recently. It is uncertain whether we would continue to meet all the nation's commitments after that date. So what would that mean? Basically nothing good, according to JP Morgan Chase CEO Jamie Dimon, who earlier this year said a default would cause a catastrophic or cascading catastrophe of unbelievable proportions and damage America for 100 years. He wants to get rid of that ceiling entirely. Okay? He wants to get rid of it. Every time they approach it, JP Morgan spends about $100 million preparing for it. So we'll see. Honestly, I get the feeling, the more and more that I'm seeing of this, it's just political theater. Just like, in some ways, I would say, all of the predictions from the RBA or modeling of a 40% housing price correction, what impact that would have on the banks, and all the articles from all the banks, all the real estate organizations that were talking about 15% property price falls, 20% property price falls, all of this stuff we were seeing here in Australia. I strongly suspect that was done to give the political will to allow the Conservatives to go nuts like they have, and forget about the debt ceiling, guys. We don't have a debt ceiling, but forget about our debt. Don't worry about it. She'll be right. Just houses. So, what it means for Aussies. As all these crises rage on simultaneously, Australia has been left particularly vulnerable, given our reliance on iron ore. Well, it's not just iron ore, it's also international migration, international tourism, international university students. A big portion of it is coal as well, but coal is getting more expensive too. So, yeah, we'll see. Australia is both the top iron ore producer on the planet and the number one supplier to China, which makes up 70% of the world's demands. Iron ore is our biggest export, but recently iron ore prices have tanked, mainly due to slowing demand for property in China, which has devastated our biggest mining firms. Yeah, but they were... Okay. I mean, look at the dividend we just got from FMG. Okay, what was it? 22% annualized? I mean, crazy, guys. Okay? So I'm sure that we are seeing some mines, mothballed or put into stand-down mode. Still, it happens all the time. I think someone told me in the comments, because... let me just check. What is iron ore as I'm recording this? 110, okay, it's still 110 USD. Apparently the cost of most of the big miners in Australia are 30 bucks a ton to get it out of the ground. So, yeah. I wouldn't say devastated is the right word there. I'd say it's ruined the good times. They're only going to make, 4 times their extraction costs. Not 7 times. Oh, diddums. Damn. Oh, well, That means the boom times could well be over, given many insiders believe the downward trend in China is the new normal rather than a temporary blip. And the timing couldn't be worse, given both New South Wales and Victoria, which together comprise around 55% of the wider economy, are in lockdown, with Australia's services and tourism industries decimated by the pandemic. Yes, but, okay, I guess that's the thing, because iron ore is pretty much all in Western Australia. Hardly any of it is coming from New South Wales or Victoria. So Western Australia is going to be hit by iron ore. New South Wales and Victoria will be hit by, are in lockdown. Services and tourism, they need to bring it back. What do we see? I think there's another article looking at approving the Chinese vaccination to allow students to come back to Australia. Okay, it'll happen, guys. It's going to happen real quick. Boom. So the October effect. This is all happening as we head into a month which has been so historically catastrophic for the global economy. It has been dubbed the October effect. The term refers to fears that October is the most likely month to bring with it stock market crashes and economic declines. And those fears aren't entirely unfounded, given the bank panic of 1907, the stock market crash of 29, Black Monday in 87, all took place during October. So, a significant week ahead. According to IG market analyst Kyle Roeder, we could be in for a significant week ahead for the markets, adding to the anxieties around growth, inflation, monetary policy tightening, China's economic and financial stability, and the global energy shortage. that sparked last week's volatility, investors are confronting a massive week of event risk, he said in a note on Monday morning. Monday brings a very critical OPEC JMMC meeting. Tuesday will see the RBA meeting. Wednesday sees the RBNZ meeting, and the US NFPs are published on Friday. US earnings season's chatter will also probably increase in volume, with Wall Street's reporting period kicking off meaningfully for next week. Well, we've had the RBA meeting here, and, well, surprisingly to no one, they are not increasing rates. They're not reducing rates either. It's sitting flat. So let's have a talk about this, guys. So is this something we need to be worried about? Is stagflation here, the Bank of America, correct? Well, we need to keep an eye out on the purchasing power of the US dollar relative to other currencies. If the cost of goods and services continue to go up and don't change over time, if this isn't transitory, if the bottlenecks that we're seeing in transportation don't disappear within the next 6 months to 12 months, well, then we're definitely in for a bumpy ride. But remember, we have to have employment shooting up as well. So at the moment, at least in the US, that hasn't materialized, nor in Australia. Even if you distrust the ABS stats, looking at the Roy Morgan stats, they're still lower than before. So let's keep an eye on it. Am I worried? Am I fearful? Do we need to start going in our bunkers, stocking up on our gold, crypto, silver, and water supplies? Not really. There seems to be a lot of fear, a lot of concern out there at the moment, and that, well, gets attention. Keep an eye on the market, prepare, be sensible, and, well, make sure you've got a diversity of investments and income streams. Like always, I don't really think the advice should change. What do you think, everyone? As always, thanks for watching. Like, share, and subscribe to the channel. Let me know your thoughts and opinions on this in the comments down below. If you're a fan and enjoy the content I put together here, there are a few ways you can help out. You can join the channel on YouTube or Patreon. Sign up for SelfWealth or Stake. Use our affiliate links at Amazon, eBay, Independent Reserve, or AussieBroadband. You can buy our merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. Take care, everyone, and I'll see you next time. Bye for now.